This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 496 was produced on September 4th, 2025. I'm Eric Townsend. The week after Labor Day has been called the most important week in markets when the senior traders are back on the desk from the Hamptons and new market trends sometimes emerge. And MacroVoices is diving into the financial high season with our countdown of the top 5 regular guests ever to appear on MacroVoices, starting with Bianco Research founder Jim Bianco, who returns as this week's feature interview guest. Jim and I will discuss whether a Fed rate cut is even a good idea, inflation risks, the unobvious relationship between the jobs report and the southern border, why cutting short-term rates could actually shock long-term yields higher, and much, much more. We're also going to experiment with a show format change. Starting this week, after the feature interview, Patrick will be presenting the Big Picture Trading Trade of the Week. Wherever practical, this will be a trade designed by Patrick and the Big Picture Trading team to express the views expressed by the feature interview guest in the feature interview. So be sure to stay tuned for that new segment right after my interview with Jim Bianco.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, September 3rd, 2025. The S&P 500 index up 81 basis points, trading at 64.48. The market price action is getting heavy right before the much anticipated jobs numbers. We will take a closer look at that chart and the key technical levels to watch in the post-game segment. That U.S. dollar index down 3 basis points to 98.15. The dollar continues to consolidate. The October WTI crude oil contract down 28 basis points, trading at 63.97. It failed to hold its breakout, leaving oil bouncing around in a trade range. The October RBOB gasoline up 203 basis points, trading at 201. The December gold contract up 542 basis points, trading to 36.35. A key breakout to all-time highs. We will talk about the upside targets in the postgame. The December copper contract up 312 basis points to 463. Uranium up 262 basis points, trading at 76.40. Finally, U308 showing signs of life after a month of sideways price action. U.S. 10-year Treasury yield down 1 basis point, trading at 4.21, trading along its multi-month lows. The key news to watch this week is Friday's jobs numbers, and next week we have the PPI and CPI inflation numbers, the ECB monetary policy statement, and the University of Michigan inflation expectation numbers. This week's feature interview guest is Bianco Research founder Jim Bianco. Eric and Jim discuss the new post-COVID economy and the new higher inflation regime. Eric's interview with Jim Bianco is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Bianco Research founder Jim Bianco. Jim, congratulations on being the first of the 5 finalists that we are interviewing in our countdown to episode 500. I want to start by clearing the air because I get almost as much credit as you get for having called the COVID pandemic back in January of 2020. I got it from you. I do take credit for being very smart. What I did was I was smart enough to know better than to not take Jim Bianco seriously. That's pretty much where my expertise started and ended. Tell us a little bit about how you got that call so right back 5 years ago, since we're starting with your track record here.
Thank you, Eric, and I'm honored to be one of your 5 finalists. It was back in January of 2020 when I saw COVID, and I got very worried that this was going to be a real big problem when I saw what was happening in China. And that was in January, and then you remember the markets ran to a new high in February, and for a while there, it looked like it wasn't going to work, and then it all came crashing down. But I also remember, I think it was late January, early February 2020, I was on a podcast with you and I think Ben Hunt. I forgot which podcast it was, to be honest with you. And we were talking about it back then at the time, and we were very worried that it was going to become a real problem. That's kind of where the origins of that came from. And I might add, as we go through and talk about some of these topics, one of the underlying themes I've been using is that event, the COVID shutdown and restart of the economy, is the biggest economic event of our lifetime. It is bigger than the financial crisis, 9/11, the inflation of the early 80s. It is really the thing that you could really, as I like to say, we are in a post-COVID economy. And too many people like Jay Powell keep talking about the economy normalizing or going back to pre-pandemic levels. It's not. That's an old cycle. We're in a new cycle altogether. So that was and continues to be a major event that people need to start thinking about, that whether or not we're past the virus, which we are we in a new kind of economy, a post-COVID economy? And I think we are.
Jim, I couldn't agree more. So let's move forward into today's economy and talk about one of those examples of something where people might be expecting it to work one way, but it might actually work a different way. And that is the hottest topic going right now, which is the Fed rate cut everybody wants. Why does everybody want the rate cut? Well, obviously, the expectation is you cut short-term rates. That's going to transmit into bringing down lower long-term yields, right? That's how it works, isn't it? Everybody knows that.
Except that's not the way it worked a year ago, because when the Fed did cut rates a year ago, you did see that long-term yields went up. The Fed cut 100 basis points and long-term yields went up 100 basis points. But going back to the whole post-COVID economy thing, if you listen to Jay Powell, if you listen to John Williams, the New York Federal Reserve president, in fact, John Williams gave a speech on this the week before we were recording, where he said it's very clear that he still thinks that the Fed's neutral rate is down around 3%. And he said that's because nothing has changed since COVID, that all of the metrics and all of the understandings of the economy are still the same. And Jay Powell seems to be saying that. A lot of people seem to be saying that the sub 2% inflation world that we had for a decade plus before COVID is still in effect, even though we're now in month 54 of having inflation above 2%. Don't worry, we're in a sub 2% world, even though we're almost now 5 years into the last time we've seen sub 2% inflation. So there is this resistance by a lot of people to say that the economy has changed. Now, I know why there's resistance. The reason that there's resistance is they'll scream at you, okay, how's it changed? I need chapter and I need verse and I need stanza and I need to know exactly how it's supposed to work. And the answer is unsatisfying. I don't know all of the answers. I just know that the old playbook you were using from 2019, that one isn't working. The new playbook that we're going to be using post 2020, we're still in the process of writing it. So I still don't know exactly how it's going to work or what is going to be the rules of the road. I just know the old ones are not.
Well, I agree with you. The old ones are not. I just want to confirm. So you're saying cutting rates looks like maybe the risk is cut short-term rates, higher yields. You're saying you don't really have a solid explanation for that other than the expectation that you cut short-term yields to long-term ain't going to work or hasn't worked recently.
Well, yeah, let me be specific. I guess I must have not explained myself well enough. The reason that you see last year when the Fed cut rates, higher long-term yields, and you see it with the ECB cutting rates and the Bank of England cutting rates, higher long-term yields, is the market, I still think, is worried that we're in a higher inflationary world. And if we're in a higher inflationary world, cutting rates is supposed to be stimulative. And what the fear is that will just stimulate more inflation. And we already have too much of it to begin with. And that's what you're seeing with higher long-term yields, compensating for that expectation of more inflation. Now, I got to be clear, we're talking about 3-ish% inflation to 4-ish% inflation long-term. It might be higher some periods, might be lower, not sub 2. And why does that matter? Because in a 3 to 4% world of inflation, and core CPI is 3.1, so we're getting to the bottom end of that range again. We've been slightly below it for a little bit while. That's what suggests that 4-ish% inflation, 4-ish% interest rates is about neutral. It's about where interest rates should be. Well, that's where we're at. We're at 4.25 on the funds rate. And if the Fed is going to ramp up and start cutting rates, they keep saying that we're mildly restrictive. They're using their pre-COVID models to make that statement. But if I'm right in this post-COVID world and we're at neutral now, they're going to go too easy and they're going to spark an inflation concern. And that's what you've been seeing with long-term yields with all the central banks when they cut rates, that long-term yields go up.
Okay, so the risk is that with an inflationary backdrop, that's where cutting short-term rates can result in higher long-term yields, potentially creating the reverse effect of the one that was intended. So it's about the inflationary backdrop that really is driving it. Jim, it seems to me like the Trump administration does not share the view that inflation is a problem. Is this a setup for them to essentially shoot themselves in the foot by unleashing inflation, by pushing for this cut?
Yeah, I think it is. You know, you're right. Trump has been very clear that there is no inflation. Inflation has been vanquished. And actually, it hasn't been, like I mentioned earlier. We're at 3.1% core inflation. In 2019, 3.1% core inflation would have been absolutely unacceptable by any metric from the Federal Reserve or the federal government. But today, now they're trying to tell me that 3.1% is no inflation. It's not. And again, why is that important? Because if it's 3% inflation plus some kind of premium on top of that, which the Fed calls R-star, we don't have a lot of room to cut rates, nor should we be cutting rates. But I also think the other problem is, I'll tread very lightly here because I don't want to upset too many of my friends in the real estate business. The absolute worst person to ask about interest rates is somebody who's in the real estate business, because they would argue to you that the proper interest rate is zero and they should go to zero and they should stay at zero all the time. When you have an affordability crisis, we should have interest rates go to zero. When you have falling prices on houses or real estate in general, that is alleviating your affordability crisis, because affordability crisis is home prices are too expensive. Well, when they go down, interest rates should go to zero. When home prices are too expensive, interest rates should go to zero. That's the problem you have with somebody in the real estate business telling you where interest rates should be, is that they always think that they should immediately be going down and they should be staying somewhere near zero all the time. And I won't just indict Donald Trump. I'll also throw Bill Pulte, the head of the FHFA, the regulator for Fannie Mae and Freddie Mac. He's been echoing similar sentiments too, that interest rates should be on their way to, something approaching zero immediately.
Jim, we've got the jobs report coming out Friday. That'll be tomorrow on the day that this podcast drops on Thursday. We recorded this interview just for our listeners' edification back on Monday of this week. Tell me about the jobs report, what your expectations are, but particularly, how does that relate to the border, something that might not be obvious?
I think that what we need to understand about job growth in the United States or any developed country is you have to start with two major factors that give you job growth. One is productivity. How productive is your economy? If it's more productive, it has room to hire more people. And the second thing is, what is your population growth? This is what the Fed refers to as the supply of labor. Now, what's happened in the last 4 months or so, 4 months now pushes us back to April or May, is the border's been shut. And Trump has been talking about that there's no more immigration coming into the country through the border. And as a matter of fact, with all of the arrests of undocumented workers by ICE, there has been, New York Times highlighted this about a week ago, we might be seeing net negative immigration for the first time in 100 years. Net negative means more people are leaving the country than are entering the country. The last time that happened was during the Great Depression, when a lot of Mexican workers left the country because there was no more job opportunities. Now, if we're having net negative immigration, let me throw in one other statistic. The fertility rate in the United States is at an all-time low and has been for decades. So all of our population growth is really coming from immigration. Well, we don't have any more immigration. We don't have any more population growth. So all you've got then is productivity to basically drive job growth. Now, the American Enterprise Institute and Judd Koklow over at the Peterson Institute. Judd Koklow is the former head of chief economist at Indeed and Trillia. They've put pen to paper and have made the case that with this lower level of immigration growth and with our kind of average to slightly below average productivity growth, that by the time you get to next year, that the break-even rate for jobs, this is a statistic we don't really talk a lot about because we never had to. How many jobs does the U.S. economy need to create? Well, the American Enterprise Institute is saying by 2026, which is only 4 months away, it could be as low as 0, or most likely it could be 10,000 jobs. That anything above 10,000 jobs a month is enough. Now, the problem with 10,000 jobs a month is President Trump just fired the head of the BLS, accusing them of rigging the numbers for political purposes. I don't think they were doing that at all. But the premise there was 19,000, 14,000, 35,000 on a 3-month average was too low, unacceptably too low. And this is the hardest thing for people to understand is, no, if we have no population growth, that's enough jobs. That's all we really need to be creating. And my fear is, going back to the Fed, if they're still of the opinion, and I think Chris Waller, who's been one of the leading voices on the Fed pushing for a rate cut, still thinks that this economy should be churning out 100+ jobs a month consistently. Now, you could do that this month, when we get the August numbers at the end of the week, for a month or maybe 2, but consistently without job growth, the only way you're going to get that kind of job creation is if you take people that are not in the workforce and get them into the workforce. Quick statistic. We always have this statistic called labor force participation rate. That is the percentage of the population between the ages of 16 and 64 that have a job. It's about 62%. The other 38% are either students, military, incarcerated, housewives. There's a reason they're not in the workforce. They're disabled or they're independently wealthy and they don't want to work. Well, to get those other 38% into the job market, you're going to have to raise wages. That's wage inflation. That's just another level of inflation. So I think that the supply argument is the problem with this is, and you hear this economist look at the numbers and go, 19,000 jobs a month, panic. The economy's going into recession. But they're not yet really get their arms around the idea of if the border's closed and we've got no population growth, maybe that's enough. That's all we need. And if you're going to try and stimulate this economy into 80,000 or 100,000 jobs a month consistently, you're just going to wind up producing inflation.
Jim, you make excellent points, but hang on. President Trump's going to go the opposite direction and say the fact that there's a low jobs report absolutely commands that we have to cut rates right now. Is that a setup for essentially unleashing inflation?
It could be. It could be very much, because he would be using that mentality because let me back up. Pre-COVID, we never ever talked about what is the potential number of jobs the economy needs to create, because population growth was fairly stable. Immigration was fairly stable. It was the same number year in and year out, around 80,000, 100,000 jobs. And we just kind of got used to the whole idea that that's what the economy should do. Well, 21 to 23, when we had millions of people coming into the country, there was an argument to be made that number had ballooned up to 150 to 200,000 jobs a month. And that's why we weren't, even though we were printing 120,000 jobs at the beginning of 24, we weren't creating enough jobs because of the ballooning population growth. And that's why we saw the unemployment rate go up. And that was last year when the Fed panicked about the unemployment rate was rising and that we need to do something and cut rates on that. Well, this year we got the opposite. Now that we've got no population growth, the unemployment rate is not rising. It's the same level, 4.2%, as it was exactly 1 year ago. That is a sign that labor demand is okay. It's just that the supply is way down. There's also one other thing that Trump has been doing, which I think is a error. He has been criticizing the Fed, and about a month and a half ago, he wrote on X, on Truth Social that was reposted on X, like a handwritten note to Jay Powell with all of the central bank rates, and he circled all the countries that have zero, and it was like Cambodia and Japan and some other countries that are very close to zero. And he said, we're the hottest, we're the best country. We should be here with these countries, not down here at 4% where we are. The error that he's making is he's thinking that the United States is like the mortgage on Trump Tower. The lowest rate goes to the best mortgage. Why do you get a low mortgage rate on your office building in Manhattan? Because you have high occupancy and you have a desire for people to want to be in there. In other words, what I'm trying to argue is you have very little credit risk. He's arguing that the U.S. has very little credit risk. I agree with him. It has practically no credit risk that the federal government is going to default, especially as a reserve currency. We'll print the money to pay you back, but we're not going to not pay you back. Where interest rates for sovereign yields are set is not on credit risk. It's set on growth, inflation expectations, and supply. And those are the things that are holding our rates up to 4%. So when he's trying to argue, we're the hottest country, everybody wants to be here, what he's trying to say is, we're a good credit risk. So it's just like the mortgage on Trump Tower. It should be lower than the mortgage across the street because it's a more desirable property and therefore it's less risk. Well, that's not how you set sovereign yields. And that's what he's going to have to resolve in this issue. And I think that the market understands that. And that's why we're seeing long-term yields still stay in this mid to high fours area, because it's not about us being the best credit risk. It's not about whether or not we're a better credit risk than the UK or France or Canada or Japan. Japan is, got interest rates that are still with a 1.5%. And it's all because of their growth and their inflation aspects and their supply situation to suggest a much lower interest rate than the United States, not about credit or their ability to pay.
Well, that's the basic theory, isn't it, of macroeconomics, is that on a relative basis, at least, the performance of one country's economy versus the other, it's the strength of the economy that determines the relative interest rates. The higher interest rate goes to the stronger economy, no?
That is correct. And that is the way it works. And that's why I use the word developed countries. Now, when you get into developing countries, that's what, then you can get into a situation where there can be a credit risk because there can be default. Venezuela famously is defaulted. Some African countries have famously defaulted as well, too. So it's a relative strength on your economy. So interestingly, when Trump says we're the hottest economy in the world, I want to say, you know what? You're probably right. And that's why interest rates should be going up, not going down. And Eric, there's another thing in this conversation I should throw out there. We've kind of gotten trapped into this mentality that interest rates, lower, always good, higher, always bad. That is not the case when it comes to government yields. It's fair value is always good. And when you deviate from it too low or too high, bad things happen. So the cost of money, which is what an interest rate is, it's to borrow money. You have to pay for it to borrow money. You want to make sure that is at an appropriate level for your economy. If it's too high and you're paying too much, you're going to retard the amount of borrowing because that's the base level, the government yield. And then, bank loans and corporate bonds have some other credit risk premium on top of that. And then there's not going to be enough borrowing in your economy and you're going to slow it down. If it's too low, you're going to overstimulate too much borrowing, too much speculation, and you're going to wind up with bubble markets and or inflation. So you want to strive to be in that kind of middle fair value range. So what I'm arguing here is down is not always good when it comes to interest rates. It's good if you make the case that we are fundamentally too high relative to the economics. And I don't think we are with a 3.1% core inflation rate. And that if you're going to force it down, I know everybody say, well, this is good. Rates are going down, but it might not be because it could be too stimulative. Just like when rates go up, it might not be bad because maybe your economy's speeding up. You have a little bit more inflation and they should be going up.
Jim, let's back out to the big picture of the Trump administration's policy goals and what they're trying to accomplish. Because let's face it, look at what happened with tariffs. They said there was going to be some tariff action, and then we got shock and awe, one of the biggest tariff negotiation campaigns ever. Then they said they were going to hold some of the previous administration officials to account for bad actions. Now we've got what seems like a massive accountability shock and awe campaign. I think the next shock and awe campaign is yet to come. And I think it is one which will be under the command of Financial Delta Force Commander Scott Bessent, who has already installed his Spec Ops Commando, Stephen Moran, in the Fed to be the inside man there. Don't forget, Stephen Moran is literally the guy who wrote the paper on the Mar-a-Lago Accord. And I think what they're doing, I'm not sure who they're going to put into the Fed and other places, but I think what they're doing is they're installing the commandos that are going to do an assault or a takedown on the global financial system and re-architect it to their own liking. And I think that's going to involve crypto integration, not central bank digital currency, but a stable coin-based crypto integration. And I think it's probably going to leave Don Jr. doing pretty well in his crypto business. I know it sounds crazy. Is that nutcase conspiracy stuff?
No, not really. I mean, there's a lot to what you just said, especially Scott Bessent being played by Jason Statham in the next movie that they do about this. But I know he'll really appreciate I said that. But I do think that you're right. Stephen Moran is the author, the architect of the Mar-a-Lago Accord he wrote last November when he was at Hudson Capital, which has been kind of like one of the papers that's been driving what the Trump administration is doing. And there is a desire to want to try and reorient the entire financial system to be more aligned with the trading system that we have. And there's no doubt that crypto is going to play a big role in that, which is why they've been pushing, the passage of the Genius Act, and they've been pushing the Clarity Act, which is supposed to clarify regulations. But I think where you're going with this is, what are they going to do with the Fed? Because, what we've got Michelle Bowman and Chris Waller. These are two Trump 1.0 appointees, which have been basically, those are the two that dissented at the July meeting calling for a cut. Chris Waller has been leading the forefront at the Fed for a cut. Andrea Krugler left the Fed early. She wasn't supposed to leave till January. She left in August. Presumably the reason is that she wanted to return to Georgetown so she didn't lose her tenureship as a professor there. She couldn't wait till January. She had to be there before the school year started. So that means that Stephen Moran goes in as a third Fed governor. And now they're trying to fire Lisa Cook for cause. And assuming that they get that done, and I'll assume they will, that would give Trump 4 appointees of the 7 on the Federal Reserve Board. Now, why is that important? For a number of reasons, and including one of them will eventually become the new chairman in May of next year when Powell's term is done. But I think it also gives them the ability to shape the Fed the way they want, because a lot of people don't realize this, and to be honest with you, I had to be reminded of it, that every Federal Reserve Bank president has a term that it runs 5 years. It ends at the end of February in years beginning in 1 and 6. So in February of 2026, all 12 Federal Reserve Bank presidents' terms expire. Now, that's been a formality for 100 years. Their boards would reappoint them, and then they have to be approved by the Board of Governors. They need at least 4 of the 7 votes to approve them. And in the last 100 years, there's never been a no vote of any bank president ever. Well, now the theory is they're all going to expire. Their boards will all put them up for renomination. And if Trump has 4 of the 7 governors, they can start saying no and effectively firing some of the bank presidents, the more hawkish ones or the ones that are not aligned with their policy, their policy aims. And they could then force those boards to go back and find somebody that would be acceptable to get past the Board of Governors, and that could help remake the Fed as well, too. Now, let me be clear. This is a possibility when you have 4 governors. It is not a certainty that they're going to do this. And again, I'll remember, the reason you've never heard this before is that no Fed governor has ever voted no on the reappointment of a Fed president. But that is something that has been floated out there as well, so that they could be remaking the Federal Reserve, the most important of the central banks, into the image that they want. So this is why you hear people talking about a loss of independence. So why is the market so sanguine about this possibility? I think twofold. I think one, it's still all theory, and we'll have to see if this is actually a little bit too, we're a little bit too over our skis with these theories. Maybe that they're not that going to be that aggressive. Second of all, I do think that the central bank has not done itself any favors with the way that they've conducted their policies over the last many years, not the least which was cutting rates last September 50 basis points. That was the first time in decades that they changed policy before and after Labor Day in an election year. Let me be clear on what I just said. Changed policy. If they were hiking going into Labor Day in an election year, they could keep hiking. If they were cutting, they keep cutting. If they were holding, which is what they were doing going into Labor Day, they would keep holding. No, they reversed and they cut by 50. And so when Trump yells at them that they were political trying to get his opponent to win, you could quibble whether they weren't or were doing it or weren't doing it. But if they wanted to do it, try and sink the election for him, that's exactly what they would have done, is an aggressive rate cut right after Labor Day. And so the timing of it the optics of it doesn't look good at a minimum as well. So they've not done themselves any favors. So when economists and Fed officials keep fretting about central bank independence, and I've heard some of them say, and the market doesn't seem to be bothered by it, I don't know why. And it's like, because you've done a pretty good job of showing yourself as to maybe not being as independent as you think you are. And the market is open to the idea that the Federal Reserve needs change. And so if there's some change at the Fed, it will embrace it. If there's too much change, meaning a loss of independence that the president is going to start running monetary policy, it might get worried about it, but it might get worried about it later on. So what I'm trying to say is, I kind of agree with you. It's a red flag or maybe a red flag is a little strong. It's a yellow flag. It's a yellow flag right now that could become red as this situation unfolds. And so, no, I don't think it's, outlandish what you just said.
Let's talk about the role of digital currency and how it's going to evolve. We started with the Bitcoin community hopeful that maybe someday Bitcoin would compete with government-issued money and compete with the U.S. dollar for global reserve currency status. I took the uncommon view that was not likely to happen. The central bank digital currency was more likely to be invented, which it was. But what I didn't see coming, and what I think is now happening, is the realization by the Trump administration that they can basically replace the petrodollar recycling system with a stablecoin recycling system that ties everything into U.S. Treasury demand, but still uses the Bitcoin blockchain in order to tokenize those assets. Is that where we're headed? And if so, what would that mean both for the people in the Trump administration and for the rest of us?
Yeah, I think, that is a way that we're headed. If there was one quibble I would give with that, it would be maybe not the Bitcoin blockchain, but the Ethereum or the Tron blockchain. That's why you've seen over the last 2 months, Bitcoin's unchanged. Ethereum is up 70%. Now, what they're attempting to do is with a stable coin, and the Genius Act also had another provision in it that really relaxed the regulations for building payment systems. So the analogy I've heard is the stable coin is the rails. We're going to build rails. We're going to build railroad tracks. And after those railroad tracks are built, will come the trains and the cars that will follow it. So if we're going to build these payment systems, these payment rails, in order to effectuate payments, that then everything else will follow. Let me give another statistic here. 80% of the world has a mobile phone. 80%. Even in the least developed countries on the planet, the majority of the population has a mobile phone. Why is that important? Because everybody has access to an electronic wallet, even in poor countries. So what they're offering is, here's a stable coin. It's tied 1-for-1 to the US dollar. It's a digital representation of the dollar. You are in a country where you've got shaky banking systems, you've got currencies that are constantly devalued. We're going to give you this tool that you can use that's on a decentralized platform and it's permissionless. So no one can take it away from you. No one can hack it or anything. You can store your wealth on that system. And we're hoping that this will attract a lot of money that people will want to, instead of using the bank account in whatever country they're in, they will use this, a stable coin, which will then be backed by a one for one by a treasury security, and then will create extra demand for treasuries. Now, I got two small quibbles with it. I understand the argument, and it could very well be the case. Quibble number one is that's not going to be the case for American investors and European investors or developed world investors. If Americans like you and me and most everybody that's listening to this podcast, or even if you're European, you say, yes, I want to keep my money in a stable coin. Well, where was it already? It was already in a regulated bank that was backed by something like a U.S. Treasury. So you're just substituting it to another Treasury-backed security or Treasury-backed instrument. So there's no new net demand. So in the developed world, there's not going to be a whole lot of new net demand. In the developing world, I could see that demand coming, but is there trillions of dollars of wealth that is being sitting around in Africa and Asia and in Southern Asia and Latin America that's looking for a more stable banking system to park it in? I don't think there is that much money out there. There was, they wouldn't be developing countries. So I think that the amount that they could very well get is going to be much smaller than they think. But let me also throw out something else about this whole idea about building rails that, payment rails that you will use a stable coin then to be the medium of exchange on that payment rail. We are living in a digital world and we have an analog banking system. And let me explain where we should be if we were. Think of email and texts. You can send as many emails as you want, and a lot of us do send bulk emails to lists or texts, and they're free. The marginal cost to send one is free, and they arrive instantaneously. Why isn't our payment system like that? Why can't I send money to everybody instantaneously and for free? And let me go you one step further. Why is it that if I agree on my paycheck, a certain amount of money per month, why am I paid lumpy once a month? Why am I not paid in real time all the way through the month? Every second, every microsecond, every minute, I get money goes into my account for the amount that we agreed on that you're going to pay me per month. Furthermore, my rent, my mortgage, every second, every minute, money goes out of my account for the agreed upon amount for rent. Now, why am I arguing that that's the kind of payment system we have, which we don't have with ACH, the automatic clearinghouse, or the SWIFT system, or this new FedNow? We can't handle anything like this. Because ultimately, why do we all pay monthly service? Why do we all pay monthly fees to Netflix or to whatever else that you want to pay? Because that's the only thing our banking system can handle. We should ideally, I'll use streaming services as my example. You should have no account on a streaming service. You should connect your wallet. You should then watch something, and every minute, it takes a penny or two out of your account, or a sub penny if it's a lesser popular show, even a sub penny. And as long as you're connected and watching it, you pay. The minute you stop watching it, you stop paying. You go to the New York Times and you want to read a story. Oh, that looks interesting. Click on it. 3 cents comes out of your account, or 5 cents, or 10 if it's a more popular story. But you don't have any monthly fees. That's the way we should be paying. What I've tried to describe is a payment system similar to the way we send texts and the way we send emails. We could send an unlimited number of them. Is whenever we want, they arrive instantaneously, and there's no marginal cost. So if I want to get paid every second, and if I want to pay every second, I should be able to. I can send a text every second if I want to. Why can't I get paid every second or send a payment every second without incurring an economic cost? And that is the type of system that I think the digital economy wants. So I'm all for what we're trying to do with this system. Now, is the Trump administration, trying to get in there with their world, financial coin and everything else? Sure they are. And the day we're recording, the Wall Street Journal is saying that they've amassed $5 billion in wealth because of it. And yes, that makes me a little bit uncomfortable that they're doing that. But that doesn't detract from the idea that what they're trying to do is a worthwhile effort. And so much of what Trump does is like this. The idea behind it is a very good one. The way he goes about doing it makes me want to question it, and stuff. Firing the BLS chief. I think the BLS has got some problems. And if you want to fire the BLS chief, I don't have a problem with it. but then accusing them of being political and partisan and trying to make them look bad and everything. That's when I start having problems. And then you're going to replace them with a partisan who's just going to basically monkey with the numbers so that they make them look good, as opposed to saying that there's been some real problems at the BLS with the way that they do this data, and maybe we ought to fix it. So the intention, the idea there, you kind of agree with. Then it's the execution of the way they want to go about it that makes me really question it.
Jim, final question. Think about the way they've taken this shock and awe approach to other policy objectives, such as tariffs. What do you think the next shock and awe things might be? What are the things we might be shocked with as they move forward on this agenda of doing something to reshape the global financial system?
Well, let's not forget immigration, too, that they've done, shock and awe on immigration as well. But I do think that the next shock and awe, if I had to guess, would be in the realm of taxes. Trump has talked about tariffs are going to be this new thing called the External Revenue Service. He believes that they're going to raise trillions of dollars in tariffs. All right, maybe they do, maybe they don't. I don't know if they are. But ultimately, what he's been arguing is that he wants to go to this idea where we could get rid of the Internal Revenue Service and replace it with an External Revenue Service. And therefore, we don't have to ever pay taxes again. I don't see us raising that. That's $4 trillion a year that the Internal Revenue Service raises. Could there be a reduction in taxes because of tariffs? Sure. But an elimination, that's a little bit too much for me to see as well. And finally, as long as I'm on tariffs real quick, I still have a question about how successful this is going to be. As I've joked a lot about that, if Trump could find a way, all tax policies always, we need to get some other rich person, not you, to pay for our taxes. We're taking it to the ultimate extreme now. The other rich person, not you, to pay our taxes now is a foreigner through the form of tariffs. And furthermore, Trump wants me to believe that we're going to get a lot of it from China so that they could take all that tariff money they got from China to buy weapon systems to protect us from China. And I said, if he could pull that off and eliminate the External Revenue Service, or the Internal Revenue Service with the External Revenue Service, then let's just put him on Mount Rushmore right now. But I say that sarcastically, thinking that it's not going to be as big as it is. So while they've got all these big plans on taxes, all right, I don't think they're going to go all the way to no income tax, but I would not be surprised if you are going to see before the end of Trump's second term some radical restructuring of the current tax law, basis on the idea that we are getting some tariff revenue and that they could start making changes.
Well, Jim, I can't thank you enough for another terrific interview and for all of the previous terrific interviews you've given us over the years, making you one of our top 5 all-time MacroVoices guests. Before I let you go, please tell our listeners a little bit more about what you do at Bianco Research, how people can follow your work, and what services are on offer for our institutional investors.
So 2 things. My original job was I am a macro researcher at biancoresearch.com. You can follow me at Bianco Research on YouTube, on X, Twitter, and on Jim Bianco on LinkedIn. We do offer an institutional product. If you wanted to request a free trial, you can go to biancoresearch.com and take a look at it. If you're not an institutional service, I do try to post a lot on social media. The second thing we do is we do manage an index called the Bianco Research Total Return Index. It's a fixed income total return index, biancoadvisors.com. You find out more about the index. It's designed to maximize fixed income returns because that's ultimately where I start and still believe I still am as a bond guy. And there's an ETF that tracks our index. It's the Wisdom Tree Bianco Fund, WTBN, Whiskey Tango Bianco Nancy is its ticker symbol.
Patrick Ceresna and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jim Bianco on the show. I loved his perspective on how things have materially changed in this post-COVID economy.
And that's a perfect opportunity to segue to our new segment, the Big Picture Trading Trade of the Week. Patrick, tell our listeners how you'd put a trade on to express Jim's view that cutting short-term rates could actually risk increasing long-term yields.
Now, Eric, Jim's got a lot of interesting takes, but the one that really stood out for me was his view on higher inflation regime and what it means for bonds. His argument is pretty straightforward. rate cuts could actually be inflationary. They juice up demand, push up inflation risk premiums, and ironically, that could lead to selling in the long end of the curve. To me, that screams steepener. I'd rather look at the 530s than the 210s. It lines up better with the idea of long duration bonds under pressure. Right now, that spread is around 121 basis points. As you can see on page 2 of the chart deck, we've moved a long way off the 2023 inversion. But when you zoom out, history is clear. In the last 2 big steepening cycles back in 2000 and 2008, the spreads widened north of 200 basis points. So there's still room to run if rates meet sticky inflation. Now, sizing the trade is the tricky part. You can't just throw on equal contracts. The 30-year moves a lot more per basis point than the 5-year. You've got to balance by duration so both sides react evenly. On futures, that works out roughly to a 4-to-1 ratio. I've attached a Bloomberg screenshot of that on page 3 of the chart deck for those that want to take a closer look. In regards to risk management, I'd keep it simple. 2 things kill the trade. 1, if inflation expectations roll back to the pre-COVID norms, or 2, bullish technicals showing demand coming back in the long end. Either of those would be a clear signal to scale back. So in that bigger picture, if Jim's right and the Fed is cutting into sticky inflation, then history says that the 530s still have plenty of room to steepen.
Patrick, that was a great explanation for our professional audience. We don't have time to delve into all the details of a retail version of this trade, so how about giving our retail listeners just a quick 10,000-foot overview?
A lot of retail investors shy away from this trade because futures and duration matching sound complicated, but you don't actually need to mess with futures to play the theme. There are simple ETF-based ways to do it. For example, you can use Harley Bassman's Simplify Short-Term Treasury Futures ETF and pair that with options on the TLT, which is the iShares 20-plus year Treasury Bond ETF. That gives you exposure to Jim Bianco's bond view without having to dive into futures.
Thanks, Patrick, and I'm sure a lot of our listeners would have liked a more complete explanation, so how about doing one of your famous big picture trading webinars on this topic? And while you're at it, how about hooking up our MacroVoices listeners with a free ticket?
On Monday, September 8th, on our members webinar, I'm going to walk through exactly how retail investors can set up trades to take advantage of Jim Bianco's bond market view with no futures required. If you're a MacroVoices listener and you want to see how it's done, you can jump on for free. Just register for a free trial at bigpicturetrading.com.
And listeners, be sure to let us know what you think about this new Big Picture Trading Trade of the Week format on X. We're experimenting with this format and trying to decide whether we're going to continue it beyond this countdown series. Now, let's move on to our usual post-game chart deck.
Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Jim's picture saying looking for the downloads.
Patrick, is starting to look like the S&P chart could finally be topping after hitting my target of 6,500. But are we topping or just pausing? Frankly, I'm not sure, and I think news flow is going to determine the answer. What are the charts telling you?
Well, Eric, I have to agree with you because this is a heavy market. While the big rally was through June and July, August has actually seen some sort of heavier distributional and topping formations developing. Now, really, the jobs numbers is going to decide what happens next. But if the market does break down in the post-jobs numbers period, it certainly has now created enough distribution along the high to kick in a bigger and deeper market correction. Now, if we did have a market correction, it will typically start with a 5% garden variety correction, which is we'll probably get down towards 6,200 on the S&P. The big tell will be if we get that type of a correction, how fast and with what velocity the bulls buy the dip. If a quick 5% correction happens and then by October we're back to 52-week highs, then actually that much needed correction would only actually be favorable for the bulls because in the end it would have unwound the overbought state of the market, create the correction and the backdrop from which a bull continuation pattern can actually happen. But at the same same time, if we had a breakdown of a 5+% variety and the markets stay down there and fail to rally and as immediately met with distribution whenever there is a short-term rally, let's say not be able to get back above 6,400 in that condition, then that could pivot a lot of systematic traders, whether the vol targeting funds that have been net buyers over the last 3 months or the CTAs that are generally net long now will start giving signals to sell, and then all the short gamma on the dealers' books could all together begin a much bigger and deeper correction that could then spur sentiment shift in the markets. Now, that's very premature to jump to those conclusions. At this stage, we are long overdue for a 5% correction, especially we're now almost 150 days into a rally off the April low without a correction. And so a correction is a very natural thing to happen. But the bigger question is, how will the bulls react when we get it? All right, Eric, let's move on to that US dollar.
Well, Patrick, we've been in a horizontal consolidation pattern on the Dixie centered on 98 for 4 months or so now. Most of the action has been between 97 and 99 with occasional excursions out to 96 or 100. But we really need to see a sustained move above 100 or below 96, which obviously is a very wide range, before we really know that we're into a new trend. And we haven't seen it yet. So my fundamental bias is unchanged, still strongly bearish, but subject to let's wait out this consolidation. I think it will eventually resolve to the downside. We'll see another leg down, but it'll be several steps before we eventually get to my target of 89.
Well, Eric, I appreciate the bigger picture bearish view because there are all sorts of bigger picture macro reasons to be bearish the dollar. But when I look at the technicals, what we see is a primary bearish downtrend that's been in place since the start of the year. But over the last 2 months, even arguably 3 months, we have seen the dollar find a fair value zone that has created the sideways trade range that you've spoken about. The bigger question here is that will that trade range act as a support line to potentially spur a US dollar counter trend rally? That would purely be technical if it was to emerge. But when you really look at the underpinning cross currencies, you can see the euro has been incredibly heavy. The pound sterling has made a decisive breakdown below its 50-day moving average. The US dollar yen has decisively broken out of a wedge on the upside, and even the US dollar CAD is actually rolling up out of a flagging formation. There's a lot of these cross currencies that are actually setting up for what could be, at least on a temporary basis, a US dollar counter trend. Now, again, that wouldn't be a big macro call, but rather a technical move. But it'll be very interesting to see if something like the jobs numbers or the Fed rate cuts actually spur a US dollar rally. We'll certainly find out in the weeks to come. All right, Eric, what are your thoughts here on crude oil?
Well, Patrick, I think this market is finding solid support around $60 WTI. The question is whether or not we're ready to mount a meaningful rally higher. Backwardation is moderating. We had more than $1 on the front spread a few months ago. Now we're down to 39 cents. Now, part of that is seasonality. It's expected that you have a lot of backwardation right around the end of summer driving season. On the shoulder season, it starts to come off. So it is a seasonality thing, but it's coming off pretty quickly. It's possible that we could be in a pattern that eventually takes us into a structural contango market. I doubt it. I think we're more likely to see this market move higher and reestablish backwardation, at least at the front half of the curve. But that's the thing to watch in my mind is if we get into a contango market, if the spreads that are currently in backwardation, if those expire and we go past them and the spreads which become the front month spreads don't move into backwardation in the next few months, that's going to tell me that maybe there is a structural change in the market that's bearish. But I think it's more likely to resolve the other way. This backwardation moderating, though, is definitely a concern in my mind, saying maybe we are headed towards a move significantly lower in prices before this is over.
Well, Eric, I want to look at this purely on a technical basis, which is that we had a substantial sell-off in the early part of August, and then we bounced. And that bounce was essentially a 50% retracement to the $66 and a very temporary close back above the 50-day moving average. And almost immediately, that was met with a huge reversal and selling it right back down towards the bottom of its August lows. This is still distributive price action. And on the short term, the vulnerability of crude oil potentially weakening is there. But there are some bullish signs. First of all, we have a key support line along the April and May lows, which overall suggests that maybe at most we have a 10% downside volatility risk on crude. But when we take a look at energy stocks, we can see very clear accumulation happening there. And the interesting part there is, what are the energy stocks telling us? Like usually if we have this kind of weak price action in oil, it usually leads to distribution in energy stocks, and that's just not the case right here. Are we in a situation where oil just needs to bang out its short-term lows, and as soon as we do that, something into October, we may see it giving bull signals on the upside? You can draw that trend line along those summer highs from the June, July, and August highs, and simply watch for when crude oil finally bases out, trades back above its moving averages, and breaks that descending trend line. If we do, maybe an oil counter trend in October is entirely possible. All right, Eric, let's take a look at that chart on gold. What's your thoughts here?
Well, as predicted here on MacroVoices, the gold market was coiled up for an upside breakout to new all-time highs, and that's exactly what we got. I think the move is on to at least 3,750, maybe 3,900 by Christmas. But don't chase it here. We got, 6 big green candles in a row. It looks like just as we're into the Wednesday overnight into Thursday session, we're starting to paint a red candle. Maybe we'll come back down at least to the 5-day moving average around 3,560 or so. We'll see what happens, but this market is extreme overbought. We could easily come back down, I don't know, to say 34.75, even lower than that, without it really even being a correction. It would just be part of the uptrend. So we're extremely overbought here. We've got to have at least some pullback, but I think we're seeing the beginning of a significant breakout that takes us probably to at least 3,750, maybe even 4,000 by Christmas.
Well, Eric, definitely a huge breakout to all-time new highs. Gold is clearly started a new bull trend. The big question here is that how does it react during a consolidation? So whenever we see a 1 or a 2-day pullback, something that gives back even up to 50% of the breakout rally, we want to see whether the bulls are buying dips. Now, what were all of its previous highs should act like support. Do we see that general accumulation in there? If we see gold continuing to demonstrate that positive bullish price action, then your upside targets are very realistic. In fact, if you take the length of the market rally from its November-December lows and use that as a measured move for an upside target, we definitely have potential to see even 4,000 on the upside by year end. So your targets of 3,750 and 3,900 are very realistic. All right, let's move on to uranium.
Patrick, the long-awaited moment is finally upon us. This week is the pivot point where seasonality favors uranium September to February approximately. The World Nuclear Association conference in London is ongoing right now. It has often in the past been the catalyst to sort of start the buying season. The fuel buyers come and get together at that conference, compare notes, go back to their offices, and start putting their RFPs together in order to buy uranium. So there's been lots and lots of action. The SPUT ATM, SPUT did another raise at the money, but most importantly, SPUT is now starting to close approximately at the money. It's been in a steep discount, which means new retail investors just coming into the market buying SPUT it doesn't really take any physical uranium off of the market because they're just buying up that discount in spot below its net asset value. It has to get up to and start to exceed its NAV in order for the fund to actually buy more physical uranium. I think we're right on the cusp of that starting to happen. That's a self-reinforcing virtuous circle once it gets going, and I think maybe it's about to get going. So everything looks absolutely phenomenally great to me, with just one really big caveat, and that is just too many people all think exactly the same thing at the same time. And anybody who's an experienced trader knows too many people on the same side of the boat means it gets really messy if there's a sudden gust of wind nobody saw coming. So this trade is not crowded overall, but almost among the people who are in it, everybody's got this idea that the WNA conference is going to be the catalyst for a big upside move. That means everybody's positioned for it. That means there's not a lot of cash on the sidelines. And that means that a broad market risk event, which, hey, maybe it looks like we're starting to see the beginnings of the S&P rolling over. If that got worse, it could easily be the catalyst to get something going in the uranium market. So it feels too easy to me. My base case is still the moonshot from here. I think this is an incredibly opportune market, but there's so many people who believe exactly the same thing. The market is probably going to throw us through some kind of loop before we eventually see much higher prices.
Well, Eric, I want to just focus on talking about uranium stocks versus uranium itself, the U308 and the ETFs or closed-end funds that track it. What we clearly have had is an incredibly strong run in uranium equities over the last few months. And it has them continuing to trade at their all-time highs. But when we take a look at the U308, it didn't move very much over that period. And what we saw was consolidation. So when I look at that Sprott Physical Uranium Trust here, what you can observe is that while we have definitively broken out of its descending trend line, we have not seen uranium prices itself actually participate with all of the euphoria or excitement in the uranium equity space. But that has changed here in the last week. We have a very clear upshoot in the U308, and these closed-end funds have all targeted back to their June highs, asking the question, is this the cycle from where the U308 underlying yellow cake commodity is actually going to catch up? And so we're certainly watching whether this breakout happens, and if it does, that could result in even a 10+% move on the upside in the next few months. All right, let's touch on copper.
Well, Patrick, we're finally starting to see at least a little bit of a bounce, but not much of one. It's kind of muted and looks like it's even starting to roll over again already. Well below the 200-day moving average, all the moving averages, really. So lots and lots of work to do to repair this chart.
Well, certainly there's been some strength in the last little bit, but what's interesting is that the copper equities are continuing to take flows and continue to do well. We are much closer to the key lows of copper for over the last year. And so I think that the asymmetry is in the favor of the bulls, just simply because I don't see copper breaking down below $4 or anything like that in this cycle. And so it's all, in my opinion, about where it's finishing off this basing and when we'll start seeing some bullish price action to the upside.
And Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Now, Eric, when we take a look at the U.S. government 10-year Treasury bonds, I know we talked about Jim Bianco's views that there could generally be a steepener and that could be stress on the long end of the curve. But when you're actually looking at this chart, we have seen throughout the summer sequentially lower highs in yields, going from 460 to highs at 450 to highs below 440. We're now down under the 420 level on yields. And more importantly, these are right along the lows of the yields for the summer. I mean, we are in a situation where if there's any technical breakdown here, we could be heading towards the April lows under 4%. When I see this chart, then I kind of step back and say, well, I do get Jim's idea that we could see the long end under stress, but technically on the short term, we could see a scenario where the yields go down and bonds rip, giving actually a better entry into that bigger thesis, maybe even several weeks from now. Let's see whether or not the 10-year yield breaks down here or not.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.